Hello, everybody, and welcome to the Docker Frontier webinar on how global supply chains will be reshaped by COVID-19. We're just about to start. We're waiting for just a couple of colleagues to join us on the line. But while we do that, I encourage you all to log into GoToMeeting so that you can look at the presentation materials we'll be showing today, and you can also participate in the live polling that will be running throughout the course of this webinar. As a reminder, you're welcome to submit questions or comments by clicking on the Q&A box of the GoToMeeting application on the right-hand side of your screen. And you can just type into Docker Frontier webinars. We'll do our best to answer the Q&A at the end of this conversation, and we'll certainly follow up afterwards with anybody whose question we don't get a chance to answer. And with this, I'd love to welcome everybody to our webinar and introduce you to some of what we are going to be discussing today. Before I get started, I realize that some of you may potentially be new to Docker Frontier, so I thought I would take 2 minutes to provide you with a very quick overview of our firm and how we work with our executives at major multinationals. We are a market intelligence and consulting firm, and we provide tailored solutions to drive growth from clients from across the B2B, healthcare, consumer, and technology sectors. Our dedicated teams serve as advisors to clients, delivering the market and industry knowledge that they need to succeed at all points in the business cycle. And if you'd like more information or request a free trial of our services, you can visit our website at dockerfrontier.com. You can drop us a note in the Q&A. We'll be in touch after this call, or you can drop us an email at info@dockerfrontier.com. Also, something very exciting that we wanted to share with you is that you can now follow our updates on a range of topics, from US-China trade tensions to looking at scenario analysis, as well as our latest forecast using Frontier View Mobile, our new mobile application, which is free to access and covers our daily curated news, insight bias, research reports, and we're definitely watching all questions related to how global supply chains are being reshaped by regulation, policy, politics, certainly are things that we comment on, and you'll be able to access by downloading this application. And hopefully this will power your daily business decisions, help you monitor markets, and inform your strategic planning. So certainly encourage you to download it and get it going. Now with this, I would love to introduce you all to the star of our show today and the author of our upcoming report on how global supply chains will be affected by COVID-19. This is Pablo Gonzalez, who'll be doing most of the talking today. He's our MD for LATAM Research. As I mentioned, the focus of today's webinar will be more around the structural challenges that we expect to see in global supply chains over the next few years and maybe even decades. And certainly not just about the impact of COVID-19, but we know that COVID-19 has accelerated thinking around some of these questions, and in some cases pushed companies to make decisions that maybe would have taken a little bit longer to make as it relates to their supply chains. So Pablo, from your perspective, would you agree with some of the characterizations that we're seeing in the media, for example, that COVID-19 has really pushed companies to consider much more drastic changes to their supply chains? Is that actually true or not?
Well, first and foremost, it's a pleasure to be here and be talking to all of our clients on the line. And yeah, I agree with you that if you read the news, it seems as if we had opened a Pandora box in which there's no sacred cows anymore as to the type of changes that companies want to implement to the supply chains. And I think we need to challenge the conventional wisdom that this is going to be a super quick process, or that companies will necessarily overhaul their supply chains. On the one hand, it is true that this has been a wake-up call for corporate centers, and they're likely to revisit their supply chains to retain or gain competitive advantage. But on the other hand, what we know is that our clients have been thrown into firefighting mode, either because they're facing much higher demand or much lower demand. Those companies facing much lower demand, they're facing liquidity problems, so they're more focused on cash containment. And what this means is that we're likely not to see meaningful change until we get out of this pandemic and companies have stabilized their operations. And you can see here on this page, we conducted a poll during the months of June and July. And you can see here that only 20% of our B2B and B2C clients will review and adjust their supply chain over the next 6 months. If you look at our healthcare cohort, that's only 6% of our clients there. So that's on that front. And then supply chains or changes to supply chains is just one of the many things that companies will try to do, right? So this to say, there's going to be competing priorities where you think about digital transformation, which is, by far, together with e-commerce, the top priority for companies after COVID, strengthening market monitoring and scenario building capabilities, not to be caught by surprise again, on future with future shocks, restructuring route to market, changes to companies' value propositions, etc. So again, we're going to see changes to global supply chains, but not as much as people think, or not as quickly as people think.
Mm-hmm. And Pablo, I guess, to what extent is this also a function of the fact that there are some short-term fixes to supply chain disruption that companies are still making their way through, and then the demand outlook longer term is still a little bit uncertain, both in terms of volume of demand and also the types of products that might be in demand, given the uncertainty around COVID's impact on consumption. What are you actually hearing from clients across these areas?
Yeah, so supply chain disruption or managing supply chain disruption is really just one of the many things our clients are having to do. If you think about what I refer to as firefighting, which are these short-term actions, right? So when you're talking about your people, corporate social responsibility, business planning, everything's changing, everything's a moving target. And at the beginning, companies were focused on protecting their employees, abiding by local healthcare guidelines, keeping morale and productivity high. Now, many of our clients are thinking about, do we want to go back to the office or not? And if so, when and how? Many of our clients were involved in fighting the pandemic, or at least mitigate the economic impact of the pandemic to local communities. And then what I was telling you about in terms of business, supply chain disruption management is one of them. Ensuring business continuity, trying to move things online. But really protecting cash has been the top priority for many of our clients. And if you think about planning, all the plans that we have for 2020, those are probably already in the garbage bin. And if you think about 2021, planning and beyond, is really going to be extremely challenging and probably the most complicated planning season that we're going to see in many years. So that's on that front. Now, we focus just on supply chain disruption. Along the supply chain, we've seen disruption in origin, in transit, in destination, or in other words, everywhere. We've seen small suppliers of production inputs almost at the verge of bankruptcies, or some of them actually went bust because big producers were canceling orders, and some of our clients had to bail out those small suppliers. The most obvious one, the closure of factories, forcing many companies to source from alternative locations or running out of stock if they couldn't. As government started to allow factories to reopen, our clients have had to make significant investment on safety measures with on their production lines, with logistic partners, invest in PPE, change production shifts. And many have focused on fewer products to regain scale. And all of this with the uncertainty, to your point, Martina, as to whether they're going to have to close again if cases start rising, and also with the huge uncertainty as to how quickly demand is going to rise. Then if you think about disruption in transit, we've seen massive spikes in air freights, container availability, land transportation, because of border controls, trackers being put in quarantine. And then finally, in destination, the biggest disruption, I would say, has been the massive transfers of customers that we've seen across channels, right? Whether from on-trade to off-trade, brick and mortar to e-commerce. And I can give you a couple of examples here as to how this has looked like.
Yeah, I would love to hear some of the examples. I mean, in many cases, these are specific situations, but so many companies have had so much disruption across so many pieces of their supply chain. Yeah, I would love to hear a little bit more about this, Pablo, and also have companies actually gotten better at managing disruption because they have had to deal with this now for 7-8 months?
Sure. So, one good example that at least everybody in the US will relate to is what happened with toilet paper, right? So many people think that toilet paper went out of stock because toilet paper producers couldn't face rising demand overall, or because they were importing toilet paper from overseas, but that was not definitely the case. There was obviously a lot of hoarding contributing to this problem, but the biggest challenge was actually that toilet papers, they just have different packaging for their industrial and enterprise customers than they do for supermarkets, right, for households. And even the paper texture and the quality of the paper might differ. And I don't want to get too scatologic here, but that's the reality. So what happened here is that as people stop going to offices, people stop going to restaurants, suddenly all the demand for toilet paper concentrated in supermarkets, and they just couldn't adapt their packaging and product quickly enough, right? So this is what I was telling you about the transfers of customers across channels. And if you think about brick mortar stores to e-commerce, many companies didn't have established e-commerce platforms, or they had e-commerce platforms, their own ones, or through third-party vendors, distributors, online retailers, but they just couldn't scale up e-commerce as quickly as it was necessary. And to your question about whether our clients are getting better, I think they have gotten better. Companies have made several investments to at least stabilize their operations. Many have built excess inventory not to be caught by surprise. Although obviously the trade-off of this is just higher working capital cost. But I don't think bottlenecks will be over until we can safely open up the world economy, or in other words, until we have an effective treatment or a vaccine. And the reason for this, I think, is just very simple. It's going to be impossible for companies to effectively manage their inventories until they have more predictability as to whether they're going to have to close down their factories again, whether there's going to be new physical restrictions on the supply chain, or just put it more simply, until they can have more predictability over their final demand. And I'm throwing here PMIs on this chart just to provide an example, right? If you look at China, so China's PMI is already above 50, which means that Chinese factories have increased production in June. And they probably have increased production because they're trying to respond to expectations of higher demand. But we really don't know where there's going to be new outbreaks in China, where demand in China is going to be lower than expected, or whether demand outside of China in Chinese export markets in Europe and the US will also be lower than expected. And we just got Q2 numbers in the US and Europe, and they were terrible, right? In some cases, worse than expected. In Mexico, we have the opposite situation, in which producers seems to be contracting production. Mexico is in the middle of its pandemic. And there in Mexico, factories are either closed, they're operating at reduced capacity, or choosing to reduce production amid weak demand expectations. But in the case of Mexico, they're very tied to the US. And if, say, there's a quick rebound in car sales in the US, the automotive sector in Mexico might forego sales if they cannot quickly ramp up production, right? So it's going to be very volatile. I can probably PMIs will go up and down, but we really do need a stable solution to this pandemic.
Yes, very clear, Pablo. And at this point, I would love to turn it to the audience for our first polling question for the group. We will share the results with you all right away. Of course, this is all anonymized, and you'll only be able to see the aggregate results. But as you've heard from Pablo, a lot of this is about the ability to do accurate demand forecasting, both the structure and the volume of demand at particular points in time. So we'd love to turn it back to everyone on the line to get your perspective on when you expect to regain the level of predictability that you had over demand forecasting prior to COVID-19. We'll just give everybody a couple of moments to answer the questions to the best of their perspective, and then we'll share the results with everybody. Okay, perfect. And as a reminder for everyone, while we are discussing some of the findings in our report, feel free to drop us a note at Docker Frontier Webinars if you would have any questions for Pablo, or you have any comments or thoughts as the conversation continues. We will do a Q&A at the end of this conversation. Okay, interesting. So the vast majority, or I guess over half of the group, expects that the demand predictability will start to become a little bit better in 2021. A good quarter, expect that to be only in 2022. So quite a lot of uncertainty still affecting supply chains as we have at least another 6 months to go into going into next year. And for those companies that expect it to recover in 2022, working very closely with the supply chain leadership team is probably going to be critical for being able to navigate some potential disruptions from demand uncertainty. Great. Okay. So Pablo, so far, if I had to summarize what we've discussed, supply chain disruption is likely to persist until the pandemic is over, although companies have improved in how they're managing it. Moving past that, as we said at the start of this webinar, we know that at some point companies are going to be ready to look at the issue in a more structural way and consider what changes to their supply chains need to take place for the long term, not just for dealing with COVID-19, and to also improve their resilience to future shocks. Could you tell us a little bit about the structural vulnerabilities that have rendered supply chains either not flexible enough or maybe not resilient enough, and we've seen that visualized through COVID-19?
Right. So, we believe there's 7 supply chain vulnerabilities that have come to the surface because of COVID-19, and I think you're right that at some point companies will want to address this, even though some of them might go away. But to your point, right, I think companies will want to make sure that they're not caught by surprise in the future. But just to go straight to the point, the first one is about too much concentration along the supply chain, mostly at the origin. So there were many companies that were single sourcing, say from China or Italy, and when these 2 countries went into lockdown, they did not have alternative production sites or could not source from alternative locations. Other companies have found that their supply chain was too long. This is too many actors along the chain or too far from one another. And this has just multiplied the number of bottlenecks they had to confront during this pandemic. Whenever a factory closed somewhere or a port, it was operating at reduced capacity, or there were border controls somewhere, or delays in customs clearance, etc. And these companies have seen greater delays in lead times than other companies that had shorter supply chains. Then we had companies that were too lean, and this was more of a problem that companies that saw massive spikes in demand were operating on very low inventory levels, which we know is the efficient thing to do. But lean supply chains are not ready for the types of sudden changes in demand that we saw and are seeing because of COVID-19. Some companies also realized that there were weak links in their supply chains, right? So normally smaller or less sophisticated players. We already talked about those small suppliers that were struggling, but this also happens with local distributors that might be too transactional, and they just don't have the financial muscle to sustain a market downturn or this type of market downturn that we're seeing because they were too leveraged. And then in most cases, and I think this has been across the board, I think it's become increasingly clear that companies, they just don't have full visibility as to what's going on in the supply chain, right? So say tier 2 or tier 3 suppliers, when have they stopped providing levels of inventory across the supply chain? There's not a lot of visibility over those, the status of custom clearance times. And then I would say the most acute is just lack of visibility over final demand, right? So many of our clients do not have information on sell out or sell through volumes along the supply chain, and this really complicates demand planning and inventory management. And then number 6, here, too labor intensive. This is going to sound obvious to most people, right? Because of social distancing, you have to stop conducted certain human activities. This is not to say that this was a mistake that people had people working or companies had people working, but rather that there were probably certain activities and processes that could have been automated that were not automated, and this just led to higher disruption than it was necessary with the current state of technology that we have today. And then we have supply chains that might be too exposed or vulnerable to abrupt regulatory changes. And during the pandemic, we saw certain governments banning exports of essential goods or healthcare products to be more concrete. But this applies as well to industries that might be relying too much on government incentives for local production or certain tariff levels to be profitable.
Mm-hmm. Great, thank you, Pablo. I think this is a great summary, and a couple of things come from it. One is that there was, of course, very substantial disruption and exposure of vulnerabilities, which typically can be managed fairly effectively with existing risk management strategies by supply chain teams, if it is limited to one country or two countries or a region. But of course, in this case, we had a disruption that was truly global in nature, and that really overwhelmed supply chains in some cases. But clearly, companies would want to be prepared for that type of event happening again and be able to respond to it, even if this is a fairly rare occurrence. And then the second component to this is there are probably some of these vulnerabilities that companies wanted to fix anyway, even before COVID-19 hit, and it may have accelerated that process. As companies tackle these vulnerabilities, do you suggest any specific approach so they can prioritize among the many solutions that they have in front of them?
Yeah, so I think, and this is not just me coming with a super complicated consulting framework, but just based on conversations we're having with clients, it all starts with regaining control and visibility, and we're going to be talking about this in a minute, along the supply chain, then quantifying key liabilities, and finally identify and prioritize solutions. And when it comes to prioritizing solutions, I think reality kicks in when you take into account not just the gold-plated solutions, but what is really the ease and cost of implementation, how it competes with their priorities. You know, thinking about change management is just extremely complex in the context of supply chains. And to the point that I was making about regaining not just control, but visibility. And by the way, when I say regaining control, we know that many of our clients do have supply chain risk management teams that run simulations and all sorts of stress testing, but their work is impaired by lack of visibility. And I think if you just look at this question here, you cannot really start identifying vulnerabilities in your supply chain if you don't have acceptable levels of visibility. I don't want to say full visibility, but at least acceptable levels of visibility over the supply chain end to end. And this is why I think, at least to me, it's not surprising that digitization is by far the top change that our clients are considering to their supply chains in the next 18 to 24 months, and almost half of our clients are going to be immersed in digitization projects. And at the end, man, if you think about digitization, it's about integrating all actors in the supply chain so that everybody has full and instant visibility over all relevant data. This is the definition of digitization. I don't know if our clients will achieve end-to-end visibility, but at least that's the hope.
Yeah, I think it's definitely an aspirational thing, especially when you have extremely complex supply chains, but it's clear that better visibility is definitely a short-term objective for a lot of companies. And presumably with that, you can also start to automate some of the identification of weak links, and you could be a little bit more predictive about disruption as opposed to kind of responding to it only once it occurs.
Exactly, and I think identification of weak links, definitely if you have already a supply chain that is digitized, you're going to be able to identify existing liabilities or ones that are very apparent, right? So if you compare the orders are being placed by final customers to, in your e-commerce platform or to retailers, and then you compare them to the inventory levels that you have along the chain or that your distributors have, again, which you might not have visibility over, you're not able to react much more quickly. However, digitization or digitalization alone, I don't think it will guard companies against big disruption, right? Where you want to call that black swan events or black turkey events. For that, companies will have to continue to rely on scenario planning and more concretely on stress testing. And this is about having a sense of the vulnerabilities that you have in your supply chain, subjecting these vulnerabilities against concrete shocks. And you have a few examples here where we're talking about a global pandemic, a volcano in Iceland, a supplier strike, abrupt FX volatility, what have you. And then once you do that, you're going to have a much more clear sense as to what is the size of the liability that you're working with, right? And this will help you prioritize the type of contingency plans that you want to put in place. If something is already very urgent or could, make you lose a lot of money in the short run, and then do more long-term planning as to the type of solutions you want to implement. Now, in order to properly calculate how much of a liability different vulnerabilities represent when subjected to different shocks, I think that technology, not just digitization, but predictive analytics powered by artificial intelligence, could be very powerful. Think about just all the simulations that you could run, right? But for the time being, I think scenario planning, contingency planning, there's going to be a lot of human creativity still that will have to be put in as part of this process.
Got it. And I guess once you have identified what your key liabilities are and which of the scenarios you want to stress test, then you have a series of options in terms of how you protect the business from those risks. This also takes us into the conversation, which I think a lot of people on the line might be thinking about, which is this question of, in order to be more resilient and flexible, is the answer to localize production or to nearshore it at the very least? What is your take on this, and how do you put this into the broader context of our conversation?
Yeah, I think this is a very good question, and I think people who work in supply chain, they will know that localization is just one of the many, many, many different things that you can do. And the first thing to know here is that the cost and complexity of different solutions will vary greatly across companies, right? Depending on how their supply chain is structured today, product complexity, the length of their sales cycles, average industry lead times, and many other factors. And just to give you an example, right, some companies will be able to say shift suppliers in a relatively short period of time, while others will struggle to find good alternatives. To give you another example, the commercial gains from, say, localizing, it could be very different if none of your competitors have local productions or has local production when most of them do, right? So I think you need to take a very granular approach here and understand where you stand here, where your competitors stand, and see really what would be the instant cost of implementing different solutions, and in relation to each of the liabilities that you hopefully identified in the previous step. And now, having said this, we can make a few generalizations as to what types of solutions are likely to be more costly or complex. So typically, the most expensive is actually relocating production plants or to add new manufacturing plants to the risk your chain or to be closer to customers. So this is when people think about localization, reshoring, nearshoring. I mean, this is very expensive and complex, especially if it leads to higher production capacity globally. Then we have things in the middle, like building surge capacity, so maintaining idle production lines in case of sudden spikes in demand. And then you have other investments that could give you speed and visibility at a much lower cost, even lead to lower production cost and risk mitigation in a smarter way. Let's put it that way. So here, what I'm thinking about are first digitization of information flows, which we've already discussed. industrial automation, investing in upgrading the capabilities of small players along the chain on things such as inventory management, logistics, sales processes through training, or even government engagement, right? Especially if your supply chain happens to be very exposed to changes to regulation or tariff increases.
Got it. Yeah, I think, Pablo, this question of a more resilient supply chain inherently comes at a higher cost is very top of mind for a lot of our clients, and especially now where we are all seeing this pressure to improve resilience at the same time as you have the biggest global recession in decades, and also presumably a longer term, more depressed purchasing power, greater price sensitivity, at least until we start to see a recovery from COVID-19. That's not a great environment in which to be drastically increasing your production costs if you don't feel like you can pass them on to customers. I mean, to what extent are you hearing this from companies we talk to as well?
Yeah, it's a good question. And again, before I show you an interesting survey, if you look at all the different options that we have on this page, and as I said, clearly the most expensive are going to be, a China +1, China +2, opening a production facility in the US when you didn't have one because you need to be closer to customers. Those are the things that are really, big investments that might lead to a higher cost. Also, we need to take into account what's the return on investment, because it might lead also to much higher sales. But at least in the short run, to your point, you're probably not going to reap the benefits of those investments right now in the middle of the pandemic. And if you look at this survey on the left-hand side, our clients are definitely worried about costlier supply chains. 30% feel that they might not be able to pass the cost of a more resilient supply chain onto their customers or partners. 19% said that the reduced efficiency of a more resilient supply chain would permanently or could permanently depress their margins or stall their ability to make further investments. And this is why I believe that some companies will have to complement changes to their supply chains with changes in other parts of the organization in order to increase their pricing power, reduce cost, or both, right? So this might mean for some companies focusing on higher margin customer segments, changing one's value proposition to achieve higher growth or increase average margins, redesigning your channel strategy to reduce cost to serve, or entering into fast-growing channels, or maybe making changes to your organizational footprint. So you have a leaner organization, an organization that is a little bit more efficient or agile.
Yeah. So this is a very controversial and critical point, I think, in terms of some of the costs associated with making these changes. And we'd love to pass it back to the audience and our listeners today to get a sense of your perspective on this. Again, as before, if you don't mind clicking on the answer that best represents your perspective in terms of where you see the biggest opportunity for your company in terms of whether it's increasing pricing power, reducing costs, or both. We'd love to get the perspective from the group. As a reminder, also, you're welcome to drop us a question or comment using the comment box on the right-hand side, and just drop it to Dakar Frontier webinar, so we'll take a look at it at the end of this conversation.
And by the way, this is other than through changes through the supply chain, right? So if you had to exclude changes to the supply chain, where would you focus?
Just waiting for a couple more answers to come in, and we'll take a look at the results. Okay, interesting. So 42% of the audience said making changes to the value proposition, which is interesting. And we're seeing a lot of B2B companies in particular pursuing this strategy, adding value-added services, solutions, or consulting components to their offering, essentially trying to escape the low-cost battle pricing that in some cases can result from this kind of macro environment. Definitely seeing quite a lot of companies also considering opportunities to increase pricing power and reduce costs through redesigning the channel strategy, making sure that you're working with partners who are truly adding value and are able to support the value proposition that you're going to market with. So certainly we are not entirely and only dependent on the supply chain, but of course that gives us optionality that is really important to consider. Pablo, moving on in our conversation, I wanted to go a little deeper into the global manufacturing question, which I imagine brought a number of people on the line with us today, really thinking about the future of what the global footprint look like, and thinking about what we're hearing in the media around pressures to localize, decoupling between the US and China, reshoring, nearshoring. We know that outsourcing certainly happened fairly quickly in the 90s and 80s and early 2000s. Do you think that global manufacturing footprints will go through another wave of transformation very quickly again, coming out of COVID-19? Or do you think this is going to be a much more gradual process?
So this is probably the most complicated question to answer, but I'm going to try my best. The first thing that I would say is that if you think about the current state of affairs, right, the globalization of global supply chains, this was possible because of the liberalization of trade and capital flow. Some people say that the globalization started in the 15th century, but if you think about the modern globalization and the globalization of supply chains, to be honest, really started after World War II with the creation of the General Agreement on Tariffs and Trade, and later the creation of the WTO. Then we saw the free trade agreements that were signed, multilateral ones, bilateral ones, and the massive spike in global trade, right, that we've seen. Then in recent years, what we've seen is a retrenchment from free trade in the public discourse through the recent trade war between US and China. But in practice, this will not mean the end of free trade, but rather a rebalancing of trade relationships. And one could say that multilateralism is suffering more than free trade per se, as the rise of bilateral trade agreements has proven, right? Even if you think about Trump's policies, right? He doesn't want to end free trade. He just wants better free trade, better deals for the US, and he's actively seeking bilateral free trade agreements with, say, the UK as we speak. So we're not going to see the type of retrenchment that people feel, but rather more of a rebalancing. The second thing here is that the factors that have shaped global manufacturing footprints are quite sticky in nature. And to prove this point, we create an index to assess the attractiveness of different countries to attract local production, looking at the 7 factors that you see here on this page. And the important thing, Martina, that I want to know here is that we did not assign factor weights to each of these factors randomly or based on our best guess as to which factors were important, but rather we inferred factor weights by regressing our index against the ranking of global manufacturing hubs based on the share that they have of manufacturing exports. So in other words, just to put it more simply, we identify the true weight of different factors based on how important they have been to corporations over the last few decades as they chose where to produce, right? And our key finding here, if you look at the percentages on this page, is that the most important factors to attract local production are actually market size and growth, followed by macro stability and the quality of transport infrastructure. That is, if you take into account China, the US and Germany. If you take out China, the US and Germany as big outliers, then other factors start to play a more significant role. And in practice, I like to think about this as if smaller markets had to sweeten the deal for investors, right? And this is when things such as wages, trade connectivity, government incentives gain a more prominent role.
Yeah, so this, what I like about this, Pablo, is that it sort of tells the story of implied priorities for companies as opposed to where we are today, because of course it's taken years for these countries to get to this level of manufacturing footprint globally. And this starts to address some of our questions about China in terms of its role in global manufacturing footprint. And I guess what you're implying with this analysis as well is that it's unlikely to significantly lose its weight in global footprint, even despite the fact that trade wars and now COVID-19 have both, of course, been challenging for companies with a substantial China footprint. Am I understanding this right?
Yes, that's exactly right. And we do need to challenge the conventional wisdom that trade tariffs or government incentives alone can significantly change the taxonomy of global supply chains. Sorry, can you still hear me?
Yeah.
Sorry, I had a little glitch here on my computer. Sorry for that. So we need to challenge that conventional wisdom that tariffs alone can significantly. Hello?
Yes, Pablo, we can hear you well.
Oh, sorry, I guess I stopped seeing my screen, but lucky to have a hard copy of my slides here. Anyways, if you cannot hear me, I guess Martina, you can text me internally. But anyways, let me go back straight to this point. So tariffs alone again will not shape global supply chains. This is not to say that companies have not moved out of China over the last few years or that they will refrain from doing so. And we have actually a lot of anecdotal evidence suggesting otherwise because of rising wages, regulatory pressure, or loss of market access, or just to move closer to customers. And this is true. It is true that an increase in tariffs of the type of disruption that we have seen because of COVID could be the final push that some companies need to move out. But if you look at China, many companies will choose to stay because it's huge. It's a huge market. The depth of supplier networks is unparalleled. They have excellent transport infrastructure. They've done relentless modernization and reskilling efforts, and I think this could start to compensate for higher wages too.
Great. Okay. So Pablo, I guess this is also linked to a little bit of what we're hearing from clients about China. And certainly when we talk to our clients focused on Asia Pacific, some of what we are hearing from them is this ambiguity about the importance of China for the Chinese market, for global exports, for the structure of their supply chain, but also the more profound uncertainty, especially for US-based companies, about the extent to which having that supply chain exposure in China is a liability or a political risk or an operational risk for their business as well. So certainly we're hearing a little bit of this. And apologies to the participants. We are bringing the materials back up to everyone, so you should be able to see the screen in just a moment. But in the survey that we conducted, which Pablo will be able to show you in a moment, what we have seen is that there's still quite a lot of question marks in terms of whether the disruption currently and uncertainty around US-China relations might lead to companies reassessing how much of their China footprint remains there. In many cases, a lot of it focused around the Chinese market, so localizing actually more in China for China specifically, reducing dependence on imports from the US, for example, including on certain more high technology products, and at the same time reviewing some of the export relationship between China and the US and trying to look for alternative locations that don't have that political baggage that comes with this. But at the board level, what we're hearing from a lot of companies is also this real unease about where this is headed long term. But we haven't really seen that translating into specific action on the ground or direct changes at this point in time. Is that fair to say, Pablo? Anything I miss here in terms of what we're hearing from companies?
No, I think you got it right. And thank you, by the way, for your patience as I was uploading the presentation again. But you see here, like the type of uncertainty that we're dealing in China is just unprecedented, right? We have 50% of our clients that have not made up their minds as to the role that China will play in their global manufacturing footprints. And then to the point that I was making earlier, there are actually 17% of companies that have already decided that they want to increase production capacity in China to serve the Chinese market, and 10% that will increase production in China to serve international markets. And again, these numbers are low, but again, if you think about that 50% of undecided companies, I don't think we should conclude that China will lose significant weight over the next few years to the points that we were making.
Mm-hmm, mm-hmm. Okay, so can we talk a little bit about the analysis around the factors that attract local production? So moving beyond China a little bit, I mean, I understand that the factors that have been most important as companies design their local global manufacturing footprints are sticky in nature. There's things like market size, for example, but that's not to say there won't be any changes. What kind of changes do you actually expect to see, Pablo?
Exactly. So there's definitely going to be changes. And to your point, although we do not expect radical change, the tide is definitely moving towards localization, where that means reshoring or nearshoring, right? So if you look at these 8 factors, which are the same factors that we have in the manufacturing attractiveness index, we couldn't obviously measure speed to market, and that brings the list to 7. But if you look at these factors, starting with government incentives, what we're going to see right now is rich countries and some emerging markets that do have the fiscal capacity, they're probably going to double down on government incentives to attract local production. And this is not just because of technology transfers. They're now going to be willing to do so to create jobs in the aftermath of COVID-19. So I think this is just going to accelerate pushing companies to localize. We have seen rising wages in China, which have already prompted low margin industries to move out of China, and China will recover more quickly than most other markets, and wages in China are probably going to continue to go up at a faster pace. We have industrial automation reducing the competitive advantage of low wage jurisdictions, and also, to be honest, raising the bar for the type of skills that workers need to have to work at a factory. So think about high-tech industries. What this means is that it might be more advantageous to move production back home or to countries where you can more easily tap into technical talent. Then we have tariffs changing the financials of certain supply chains. And although this is not the most important factor, as we demonstrate through our analysis, it could give the final push to some companies already under pressure because of low margins, regulatory pressures, loss of market access in China. Then, if you look at number 7, speed to market, we have also seen rising expectations on the part of customers for faster delivery because of the consolidation of e-commerce, and this is just exploding right now, and this will push companies to produce locally, especially fast-moving consumer goods. And finally, we have governments that might put specific sectors deemed strategic to have local production, especially on the healthcare side after COVID. So definitely a lot of these factors pointing to a rebalancing towards localization.
Mm-hmm. And there was going to be an industry angle to this, I imagine, as well. Which industries do you think are more prone to further localization beyond where they currently are?
Right. So probably the list can be enlarged, but just based on everything that we've discussed, we see 6 sectors that are more prone to localization in the short run. So first, we see sectors deemed, as I was saying, essential for governments. And I think here there's going to be a redefinition on the part of many governments as to which sectors should be strategic. After COVID-19, I think many governments were very happy to have mask production or hand sanitizer production or PPE production be very far away from their markets. But I think the pressure is going to be for them to either stockpile a lot of this equipment and products, or take the opportunity to develop sort of domestic production out of these products. And this could actually broaden the conversation to the food security, energy, and things of that sort. Now, go ahead, Martin. I don't know if you wanted to say something there.
No, I think this is very consistent with what we're hearing as well.
Okay. Then, as we've said, there were some companies that are on the fence or were on the fence about staying in China. And, either tariffs or COVID-19 and all the disruption that they've seen stemming from COVID-19 might give them the final push, as we've said. Low margin industries are highly exposed to tariff increases. Then cutting edge industries, and because of the early stages of development, rely very heavily on government subsidies. And therefore, I think they can be lured via tax or market access incentives much more than other industries. And think about Tesla, how it started in the US, how many very early stage companies are trying to develop innovation, and it might move across jurisdictions, to be honest, based on what the different countries offer them. Then industries that can be automated and that are in growing need for technical talent. And finally, fast-moving consumer goods companies because of the growth of e-commerce and the expectations of fast delivery that come with it.
Got it. And Pablo, last question for you, which we will follow up with a last polling question for the audience, and then a bit of Q&A. So if anybody has questions they'd like to drop us, please do so. We would love to do a little bit of Q&A at the end of this conversation. But back to you, Pablo. There are a lot of questions out there about who's going to win from some of the decoupling happening between the US and China. People are asking about places like Vietnam or Mexico or maybe even India. What is your sense of which locations are more likely to benefit if companies decide to nearshore production?
Right. So I think that in order to answer this question, the Global Manufacturing Attractiveness Index, or GMI index that we create, I think it comes in handy. And if we focus on countries that are not top one in their regions right now, so thinking about APAC right now, South Korea and Vietnam, definitely very interesting alternatives to China. South Korea, for instance, has free trade agreements with China, the US, and the European Union, so very strong player there in APAC. Mexico is a good alternative to the US, and they also have free trade agreements now with the entry of force of the new NAFTA agreement. And Mexico, to be honest, could be an interesting location, not just for the US, but for the rest of LATAM, and even become a global hub. They're very competitive in terms of wages, for instance. Then for Western Europe, you have places like Turkey and Poland, which have already become very interesting hubs for companies to nearshore. And if you think about MENA, you have Morocco, Egypt, and South Africa. But again, here we're using the same weights that we found as being the most important factors that companies have taken into account. But obviously, this index can be massaged in many different ways, depending on the industry you belong to, the types of things that matter most to you, right? So just to give you an example, if you are interested in low-cost jurisdictions, then the list of interesting options can be expanded to, say, India, Indonesia, the Philippines, Thailand, or even, again, Vietnam. For hubs in APAC, Romania, Slovakia, Hungary as alternatives in Western Europe. And Ethiopia, to be honest, has become a very attractive, low-cost, super low-cost hub for clothing and textiles that can compete with low-cost alternatives, not just in Africa, but even in Asia, right, in Asia Pacific.
Great, thank you very much, Pablo. So this is definitely a very interesting analysis to help us think through where we might be able to see some of that manufacturing potentially reshoring. And of course, there will be big differences industry by industry as well. But with that, we wanted to ask the final question back to the audience. So this will be our last polling question for today. And in particular, looking to understand your opinion on which region or country you think is best positioned to increase its weight in global manufacturing over the next 10 years. So you can put on your long-range planning hat and give us your sense of where you think some of that weight of manufacturing is likely to be shifting towards over the next decade. And meanwhile, if you have any questions, please let us know. We will be moving into the Q&A section in just a moment. Just waiting for a couple more responses, and we'll be sharing the results with everyone. Interesting. So I would say I am not extremely surprised by this result, with a big weight on Asia Pacific, where we know that parts of Southeast Asia in particular have started to attract manufacturing due to their labor costs being a little bit lower than in China, for example. China itself still is likely to be attracting quite a lot of manufacturing investment over the next 10 years, and then other markets as well across emerging EMEA or Latin America, etc., receiving a little bit more of an investment. We're hearing about markets like Ethiopia, for example, and companies really trying to look for where the opportunities are in terms of the next frontier from a local production perspective. Pablo, any perspective on this, or are you surprised by some of the results that you're seeing here?
No, I think Asia Pacific was my top one choice. And there's one factor that we didn't talk about much, which is the fact that Asia Pacific is going to recover much more strongly from COVID-19, right? So if you're thinking about market size and opportunity, definitely APAC will be probably the most attractive region over the next 10 years. So it doesn't surprise me. And then the hypothesis that we had that China will not lose a lot of weight. They might lose some weight in global supply chains. You know, when you see 22% of respondents actually think that China will gain weight on global manufacturing footprint. So I think that was very interesting to see as well. And in terms of others, I know that we threw a bunch of regions there: Central Asia, Latin America, MENA, SSA. So it's very hard to know which one of these regions might have opportunities, but my bet would be probably that people are thinking about LATAM for nearshoring, and especially Mexico for the US.
Okay, fantastic, Pablo. So with this, I'd love to move on to the Q&A section and take a couple of questions for the audience before we wrap up. We have one question, Pablo, which goes back to the digitalization discussion that we had around having better transparency, faster responsiveness in supply chains. And the question is, what role do you think blockchain can play in the digitalization of supply chains? Can they help for faster responses and better transparency? What do you think?
Well, we're not technology experts, but I think a blockchain, for what I know, it's definitely, you know, the ultimate solution for being able to trace products along the supply chain. So I don't know if it will be a substitute for digitization projects or rather a complement or a part of it. So I think blockchain has a lot of potential in that sense. The other, I think, factor to take into account in terms of blockchain, it might not even just be a factor of gaining visibility for the sake of making the global supply chain more efficient or more flexible. It might even become a customer demand, especially for consumer goods, where not just millennials, but Generation Z, they're increasingly concerned about labor laws and where the product was produced, respecting labor laws, environmental laws, etc. So I think customers, especially again in fast-moving consumer goods, will increasingly want to know where the product is coming from, how it was produced, etc., etc.
Great. We also got another question, Pablo, which is great and also big in scope. So I think maybe we try to answer it briefly. But the comment was around whether we have any observations around the front end of the supply chain, because a lot of what we focused on today was the back end of it. Do we have any observations in terms of what companies are doing with their channel partners, downstream integration, etc.? Any perspective on this, especially given the disruption that COVID has had on the financial health of partners, for example?
Yeah. this is a super interesting question, and to be honest, I don't think hopefully we will not see this type of crisis again in our lifetimes. But if I think about previous crises and how previous crises affected distributors, it was very disruptive for them, especially for those transactional, smaller, less sophisticated distributors that they just don't have the best, say, cash management or inventory management situation, right? So DSOs are definitely increasing. There's a lot of questions that we're getting about, do we pass on the FX cost to our distributors and in emerging markets? And some currencies have depreciated by more than 30% since January. So how do we help them out? Do we focus more on the strategic ones at the expense of the smaller ones, but they might go bankrupt if we do that? So I think it boils down to having visibility over the financial resilience of the distributors, choosing very carefully who do you want to bail out, and definitely if you invested over the last few years on scorecards, capability development on those distributors, I think you're going to be in a better situation right now. And there's probably, more structurally speaking, many of our customers thinking about, does this open the need to enact channel transitions? Do I want to go direct? Because I just have too much liability depending on these distributors in the future. But again, I don't think this is going to be a thing that is done in the next 6 months.
Great, thank you very much, Pablo. We are now at the top of the hour, so we'll be closing this conversation. But thank you very much, Pablo, for your insights and the materials, and thanks everybody for joining us. You will receive the recording and the presentation deck, so you have access to these materials. And again, we encourage you to join our mobile application where you can continue to monitor how some of the factors affecting global supply chains are likely to be developing, and our commentary on those. And with this, we wish you a great rest of your day and look forward to speaking with everyone again soon. This concludes our webinar. Thank you very much.